In this free video course, you will learn everything you need to know about the Wyckoff trading method, whether you are trading stocks, crypto, Forex, or any other financial market. By the end of this course, you will not only be able to trade the Wyckoff method correctly, but you will also learn about multiple Wyckoff trading techniques that most traders don't know about. Alright, so let's begin here by taking a look at what you can expect to learn from this course. And the very first thing we are going to take a look at is, of course, what is Wyckoff trading? Because before we can start using the Wyckoff trading method and apply all of the laws and all of the trading strategies to make money, we first need to know what Wyckoff trading is in the first place. And in this first chapter, we will also take a quick look at who was Richard Wyckoff. He is the man behind this method, and we'll take a look at, why should we follow Wyckoff? I can already give you guys a little hint that Richard Wyckoff, is actually, or you could see him as one of the fathers to the more modern smart money concepts. So that chapter is super interesting and a great chapter to start off the course. But right after that, we're gonna dive into the Wyckoff trading method, and we're gonna start here with something very important, and that is Wyckoff's 3 trading laws. Don't worry, we will go over every single law step by step, and these laws will be super important for later on when we use trading strategies. Another core concept of the Wyckoff trading method is the understanding of something called market cycles and market phases. So make sure, guys, to really pay attention to these chapters when we talk about the market cycle. And I can actually already mention here that I have built this course in a sort of step-by-step manner. So I highly recommend that you start with chapter 1 and then move to chapter 2, because each chapter will benefit from the previous chapter. So preferably you don't want to skip any chapters, but if you want to, and if you are certain that you already know a chapter, feel free to do that. But now, after we have been talking about market cycles and phases, we are going to dive even deeper into 2 concepts you might have already heard about, because I hear many traders talking about it, but I don't think too many traders actually understand it, and that is accumulation and distribution patterns. These can be a little bit complicated in the beginning, but I will do my very best to break them down in as simple as possible language. After we have been talking about accumulation and distribution, it's time to dive deeper in some key, both price, but also volume patterns. As you will learn throughout this course, Wyckoff thinks, price action is very important, but he also puts a lot of importance in volume analysis. So we will take a look at both price and volume, and more importantly, how these forces actually can work together. And last but definitely not least, we will take a look at, in a step-by-step manner, some of the Wyckoff trading strategies. But as I already mentioned earlier, before you can apply these strategies, it's very important that we first learn about the method. We can't, just dive straight into the strategies without having the theory, because if you do that, you will have a significant, or at least much higher chances of actually, accumulating losses. Also, if you want to have a quick reference point, you can look at this little image right here. This is basically the course. We start off with Wyckoff trading, move into the laws, market cycle, accumulation and distribution, and last but not least, we're gonna take a look at trading strategies. So yeah, guys, I'm super excited. Let's get started right away. But all right, so what is Wyckoff trading? Well, right here to the right, you can see an image, and this is just one example of a large framework that Wyckoff has created called Accumulation. And when you look at this framework right now, you will probably think that this looks super complicated, or at least some of you guys might be what am I even looking at here? But don't worry, throughout this course, by the end of this course, you will know exactly what that is. But now, first of all, what is Wyckoff trading? Well, the Wyckoff trading method is a technical analysis approach developed by none other than Richard Wyckoff. And what are the key principles in this technical analysis approach? Well, the first key principle here is understanding market structure. And if you guys have been following my channel, you know that I talk a lot about market structure. That is a very important part of technical analysis. Market structure and price action, the most important parts. So one key principle is understanding market structure, but also something called market cycles. And this is when this image comes in, because this is a part of the market cycle. And as I said, don't worry, we will talk all about that later in the course. But now, another key principle is identifying the actions of large operators or large traders. This right here is what is referred to as smart money. And you can think about smart money as, the very large players, like for example, banks or hedge funds, or in general, people that has lots of money, lots of capital. So we want to, using the Wyckoff trading method, we want to be able to identify these moves that are created by the smart money. Another key principle here is that we want to be following Wyckoff's 3 laws, and we will learn everything about the 3 laws very soon. Last but not least, and this is very key, we want to be trading in harmony with market trends and also in harmony with the smart money. You might have heard about a concept called smart money concepts, and this actually is built at least partly on the Wyckoff trading method. And the concept here is that we as small traders like you and me, we want to trade in the same direction as the larger players, because if we can sort of ride on their trades and their waves, we will have better odds to be successful and as a result make money. But alright, so now you might of course wonder, who was Richard Wyckoff? Or in other words, who was the man behind the Wyckoff trading method? Well, Richard Wyckoff was a pioneering stock trader, or in other words, a very sort of famous and very good stock market trader and market analyst. And this was way back. This was in the early 1900s. And this is one thing that is so impressive with this method, that it was created a long time ago, but many of the principles are timeless, so they still work today, and traders still use and highly respect Richard Wyckoff. And what did Wyckoff do? Well, he spent a lot of time studying successful traders of his era. And from these studies, from looking at how other traders, interviewing other traders and looking at how they trade, he developed a systematic approach for technical analysis. So this is what we're gonna learn in this video. We're gonna learn his exact systematic approach. And what did he do? Well, his focus was in understanding supply and demand. This is something we have already been talking about a lot on this channel, but also market structure, also very important, and last but not least, volume. So he combined all of these factors into one, and all of these factors are important. And as I already briefly mentioned, his methodology is still widely used today in stocks, Forex, and also now crypto trading. Even though crypto trading was of course not available at Wyckoff's time, it's still widely used in crypto trading today, because these principles are not only working for a certain market. They work across markets. But alright, so now then, why does Wyckoff trading work? Or at least, what is the theory behind why Wyckoff trading works still today? Well, as I mentioned briefly, the principles for his trading method is timeless. And one of the main principles here is that markets move in predictable cycles. So here to the right, we can see a sort of little image. This is a very simplified image of how the markets move. But they basically go from being very oversold. This is the accumulation area. So it goes down to the accumulation area. This is an area where smart money is buying, and often in secret. They are buying and buying without trying to move the market. Then we have the markup. This is the sort of bull market. Then we have the distribution, and this is where smart money secretly sells. And then we have the markdown. And all of these price movements, the driving force is supply and demand. And we will talk about more of that soon. But one timeless principle is that markets move in predictable cycles. And these are, pretty much all economists agree that we are moving in cycles. But, many different people disagree about, how exactly these cycles are. But nonetheless, Wyckoff developed a specific framework for this. And his theory here is based on that large operators, which is known as smart money, think about banks, think about hedge funds, and so on and so on. They leave footprints that can be seen on the chart. So if you are a bank and needs to buy a lot, that will mean that you will push up the price a lot, and that is like a clue that we smaller traders can then use in our trading approach. And here, once again, another timeless principle is that market structure and price action tells us a story of how supply and demand has acted in the past. So remember, supply and demand is the driving force behind all price movement. When demand is greater than supply, the price is going up. When supply is greater than demand, price is going up. And we can see this in the market structure. And we can also see this in the price action. The price action is the live movements of the price. And one key principle of Wyckoff's theory is that reading these patterns can give traders an edge. This is a very important part of the theory because without an edge, we as traders can't make money. An edge basically means that if we have a large sample size, so if I take 100 trades and have an edge, I should make money. But if I have an edge and maybe I only take 3 trades, I can simply be unlucky and lose with an edge. An edge means that if you follow this, if you are disciplined and follow your strategy and have an edge, you will make money. Last but not least here, another principle is that these principles are applicable, or you can use them in any financial market. So whether it's crypto, Forex, stocks, and also here, and this is very important because I get a lot of questions for you guys on videos, what is the best time frame? What time frame should I use this on? And this principle are applicable in multiple time frames. But here I want to give a little warning. And that is that if you are trading something on the low time frame and you are not having lots of volume, then these principles, at least from my own experience, they lose a lot of value. So they are a bit, I would say in general, they are a bit more significant on higher time frames and on high volume markets. But that doesn't mean that they have no value in the short term. Alright, okay, so now we have arrived at a very important part here in the course, and that is Wyckoff's 3 trading laws. And let's begin here with law number 1, and this is the law of supply and demand. And here to the right, you can see a classic supply and demand curve. If you have been studying economics, if you didn't know, I have a bachelor degree in economics. You have seen many of these graphs before. It's not super important to understand that graph, but what I want you guys to understand is that, supply and demand, drives the price. So if we, for example, here you can see the demand curve. The demand curve is sloping down because the lower the price, the more people want to buy of something. So say, for example, if someone sells ice cream, the lower the ice cream cost, the more people in general want to buy that ice cream. So this is why the demand curve is sloping down and the supply curve is sloping up. But the important part here is that if the demand shifts at a certain price, so if the demand curve shifts out to this, you will see that this will actually drive the price up here. And as I said, this is not really important to understand, but what you need to know is that supply and demand is the force behind price movements. As long as you know this, you are good to go. So here, what you need to know is that prices rise when demand exceeds supply. That is all you need to know about demand, and all you need to know about supply is that prices fall when supply exceed demand. Don't focus on this graph if it's complicated, just focus on these points right here. And if you anywhere in the course, feel like I'm going too fast, feel free to just go back in the course, play it over, and also, of course, drop questions down below. But here, and this is an important factor of supply and demand, is that we're not just looking at price, we're also looking at volume. Because as you can see, volume and price action reveals who is in control. And this we'll talk a lot about later, but if we have a price movement with lots of volume, it's more significant than if we have a price movement with little volume. So for example, here's a clear example. If we have rising prices on high volume, it means strong demand. But alright, so now it's time to take a look at the next law. And the next law, law 2, is called cause and effect. And if you wonder why I have an image of gold, that will be clear very soon. You will understand that soon. Because here, the law of cause and effect states that big price moves originate, or this is a fancy word for comes from, periods of preparation. So these large price moves, like for example, you can see here, we have a massive move to the upside. These large moves often comes from long moves here of preparation. This right here is what is known as a trading range, and this right here is what is known as a trend. So trading ranges, the cause comes before trends, which is the effect. This right here is the cause and effect relationship I just talked about. And here, and this is very important, this is something you can write down. In general, according to Wyckoff, the longer the cause, the greater the effect. So to visualize this, if we just have a short trading range, maybe the trend for this after the trading range will only be short. But if we have a very, very long trading range, many times the trend that comes from this range will be much longer as well. So the longer the cause, the greater the effect. At least here, according to Wyckoff's second law. So a simple example could be if we have a 6-month accumulation. If you don't know accumulation, we will know about this very soon, might lead to a major bull run. And a quote you can sort of memorize to remember this effect is that the longer the base, the higher the space. So the longer the base here, the higher the price will fly up in space. Or it's important to state not will here. And this is very important when we talk about anything in technical analysis, that all of these theories, whether it's price action, market structure, or Wyckoff theory, they never predict prices with 100%. The best thing we can do is try to get the odds in our favor. But alright, okay, so now the time has come here for the third Wyckoff trading law. And this law right here is called effort versus result. And what do we mean by this? Well, Wyckoff defines here, or tries to simplify, volume as effort and the price movements as result. And when the effort and results align, the trend tends to continue. This is bullish for the trend. But when they diverge, so when effort and result goes in opposite direction, this is a sign of a potential reversal. So as a simple example, if we have high volume effort but the price is just seeing little progress, so we might have lots of volume but little price movements, this can actually be a hidden opposition and might lead to a reversal. So what we're looking out for in general, let me try to demonstrate this, is that if we see a strong price movement, we also want to see strong volume. This is the best sign. But if we see a strong price movement and either we see just little volume, so we don't see a lot of volume, then this move is not as good. And for this principle, I have a nice little table I have made. If you want to, feel free to screenshot this table and save it as a cheat sheet. But what you can see in this table, you have the price movement, volume movement. You have if they go in the same direction, that is convergence. And if they go in opposite direction, that is divergence. And you can see if it's bullish or bearish. So for example, when the price rises and volume rises, that is convergence, meaning that they go in the same direction. And that is bullish. And the same thing here, if price falls and volume falls, that is also bullish. Because let me show you, if we have the price falling here, but we only have little volume, remember, this is a divergence between the effort and the result. So this is actually an indication of a potential reversal. But here, when we have price rises and volume decreases, that is bearish. When the price falls and volume increases, that is also bearish. But yeah, guys, make sure to screenshot this image and have it with you, throughout the rest of the course. But alright, guys, so now it's time to take a look at one of the most important parts of the Wyckoff trading method, and that is the Wyckoff market cycle. And right here, you can see an image of the Wyckoff market cycle. And as you maybe can see, it consists of 4 main phases. And let's take a look at these phases one by one. So let's start to understand the market cycle. First of all, we have phase 1. And phase 1 is known as the accumulation phase. And the accumulation phase is a phase here that starts. It usually starts after a move towards the downside. And the actual phase itself is mostly sideways movement. So this is a long phase of sideways movement that comes after, or most of the times, it comes after a downtrend. And during this accumulation phase, one important part here is that this is a phase where smart money is buying, or in other words, they are accumulating. And they buy in this phase in a very specific way, because these smart money players don't want to buy too much because they don't want to push the price up. Because before they push the price up, they want to buy a lot. So they want to take their time and buy a lot of whether it's a stock or a cryptocurrency or a Forex. So this is, where smart money is buying. They are very patient. And it's also important to mention that retail traders and investors like me and you, we are usually not really interested in these phases because these phases are often boring. We small traders often are busy with these kind of phases, markups, when everything is hype, when, Bitcoin is pumping 10% every day. These are the kind of markets that we usually want to trade. But smart money, at least according to Wyckoff, tend to focus on these boring markets when they are secretly buying. And this leads to our next phase. Phase 2 is the markup. This is the classic uptrend. And the markup is usually started here, or it can be started by smart money itself. Maybe smart money has finally bought enough, so they have a pretty large position, and now they feel like now we can finally start pushing the price up. So they might, buy aggressively here and start a price movement. And once the price start to go up here, then more and more small traders like me and you will start to find out about the price, and we will start to buy more and more. And this will be a sort of self-fulfilling cycle, that the more the price goes up, the more traders want to buy, and the more buying pressure and the more demand we see, and so on and so on. So this is usually called, what is it called? This is like a virtuous cycle, I think is the name. So that is basically the markup phase, also known as the uptrend. Next, phase 3 here is known as the distribution phase. And this comes after a strong uptrend. And this is pretty much the opposite of the accumulation phase. So this is where smart money starts to sell. Because remember, they bought a lot down here. So when the price is up here, smart money is in a lot of profit. But for the same reason as before, smart money don't want to sell everything at once, because if they do that, they actually risk to crash the market. So what they instead want to do is that they want to slowly sell while buying pressure is still coming in here from retail traders. So they take their time to sell here, and maybe, you know, at the end of the distribution phase, they maybe only have, you know, some positions left. So they sell a little bit of extra, which actually starts the next phase here. The final phase is the markdown, or also known as simply the downtrend. And just as how an uptrend can lead to a cycle of more and more buying, a downtrend can lead to the opposite cycle of more and more selling. You know, price going down leads to people being fearful, which leads to people selling. And this new selling leads to people being even more fearful, which leads to even more selling. And this is a fascinating thing about downtrends, that downtrends tend to be faster and more violent than uptrends, because fear is often a stronger emotion compared to greed or euphoria. So these markdown phases can be really brutal. If you remember, for example, the crash we had during COVID, that was a brutal crash because of all the fear in the market. It was super violent. And that is a general thing to have in mind for these markdown phases. All right, so now it's time to dive deeper into the Wyckoff accumulation phase. Because in order to use the Wyckoff trading method effectively, we need to have a deeper understanding about these different phases, especially the accumulation and distribution phase. So right here on the image to the right, we can see a more detailed picture of how a Wyckoff accumulation could look like. And there are a few important things that I already need to mention. The first thing is that right now you might wonder, you know, what does this PS mean? What does AR mean? What does SC mean? And so on and so on. And it might look very complicated. But once again, don't worry about that. You will learn what all of this means very soon. But for now, what I want you guys to know here is that this is not, you know, a perfect picture, and this is not how every accumulation will look like. What I have seen on, you know, Twitter and, you know, on social media in general is that people usually try to find charts that look exactly like this. And this is not the purpose of this image. The purpose here is to have a model so that when you see this kind of market structure, you can identify that this is likely to be an accumulation phase, and later on that it's likely to be a distribution phase. This is not a perfect one-to-one map of how the price would look like. I thought it's just important to get that out of the way, you know, right away. And that was not what Wyckoff meant to do with these kind of movements. It's a general map to have in mind. But now, when we have that out of the way, the Wyckoff accumulation phase is basically, you can think about it as building a base. And a few important points to have in mind here is that, first of all, the accumulation phase occurs after a downtrend. We can also have a similar move after an uptrend. So sometimes you will have an uptrend and then you will have a long trading range. this can actually look like an accumulation range, but most of the times the real Wyckoff accumulations will happen after a downtrend, and you can see that demonstrated right here. So before the accumulation happens, we usually have a downtrend. And the main part here with the Wyckoff accumulation is that large players, aka smart money, absorb supply at low prices. Or to simplify this, smart money wants to buy as low as possible. That is the goal here in the accumulation for smart money. And during the accumulation phase, you will see that price action will flattens and move in a trading range. So it will move up and down, but it will mostly move sideways. The general price movement in the accumulation phase is sideways. And here, and this is very important, when we are in an accumulation phase, the public and so media like news and so on are often very bearish. So they will, for example, talk negatively about the stock or negatively about the cryptocurrency. Think about, for example, Bitcoin. When Bitcoin have accumulation phases, this is usually the time when media is talking very much, shit about Bitcoin. But this is also the time where smart money secretly buys. So smart money is buying, but the public is bearish. And here, and this is very important because this we will use later on in this course as a trading strategy. The accumulation phases often end with a spring, and a spring is a form of false breakout or false breakdown. So for example, on this chart right here, you can see my camera is a bit in the way here, so let me just make myself a little bit smaller. You can see that we do have a slight spring right here, and the spring is when we have a support and the price quickly dips below and it absorbs a lot of demand and then quickly pushes above. And the very important part about springs here, let's think about it. If we manage to find these springs are actually the absolute best way we can buy. Because remember, this is the lowest part of the Wyckoff accumulation. If we really have found a Wyckoff accumulation, this right here is, the trading range before a large uptrend. So if we as traders can find real springs, these are usually excellent buying opportunities. And later on in this course, we will take a look at a spring trading strategy. So definitely guys, stay tuned for that. But alright, so now let's dive a little bit deeper into the markup phase. And the markup phase, another word for this, which is much more common, is the uptrend. A markup is simply an uptrend. So as you can see on the image right here, we have another representation where the accumulation phase, you can see right here, we have the accumulation phase. You can see we have a little spring right here, right? We have a spring, and the markup is essentially the move right here. And you can see in this particular example, we actually have a sort of phase right here as well, which kind of looks like an accumulation, but more on that later. But all right, so the markup or uptrend, what are some things we need to know about it? Well, the first thing here is that it comes after a successful accumulation. And in order to have a successful markup, we need the price to make both higher highs and higher lows. So if this right here is the trend, we need to have both higher highs. So here we have one high, higher high, higher high. But we also need to have higher lows. So we have one low, higher low, higher low. In order to have a real uptrend, we need both. Next, what we need to have in mind, and this is very important, that in order to have a strong uptrend, what we preferably want to see is that we want to see that volume expands when the price goes up and contracts on pullbacks. So to make this clear, if we have an uptrend like this, we want the volume to increase during the parts when the price go up, but decrease during the parts when the price goes down. Increase right here, decrease right here, increase right here, and so on and so on. This is the best case scenario if we want to have a strong uptrend. And remember here that we can use the Wyckoff trading method, as I said, to trade in the accumulation phase. For example, we can try to find these springs. But some of the best trading strategies are actually inside uptrends as well. So we can use the Wyckoff trading method to trade in both accumulation phases, but also in the actual uptrend or in the actual markup. Another point, and this is very important, is that these uptrends may include something called reaccumulation. So we can have an uptrend that goes like this, higher highs, higher lows, but then it might have a pause here with a trading range before actually continuing the uptrend. And this you can see on the image example right here. You can see we had the accumulation, we have the markup, we have some building pre-tension, but then this phase right here appears. And this is a classic example of this reaccumulation pause. And also the uptrend is the most profitable phase here for those who bought down at the accumulation. Alright guys, so now it's time to take a look at the Wyckoff distribution phase. And this phase right here is definitely one of the most important, Wyckoff concepts to learn. But if you look at this image and think that this looks complicated, for example, what does, all of these things, PSI, AR, BC, what do they even mean? Don't worry guys, I will talk all about that later on. But for now, what we need to understand is just the basics of the distribution phase. And let's take a look at that step by step. And first of all, another name for the Wyckoff distribution is called the topping process, because this is usually when the price really starts to top off before a large downtrend. So you can already start to notice why these distribution phases are so important to be able to spot. It doesn't matter if you are focusing on going long or going short, because if you are going long something, you of course want to know when that trend ends. And if you want to short something, you of course want to know when the next bear market or next downtrend starts. So the Wyckoff distribution is important for so many reasons. But now, the first thing is that after a bull run here, large operators take profits. And this act of large operators, or in other words, smart money, right? When these big players start to take profit, this can actually slow down the trend, and eventually the trend can lead to a halt, because all of the selling pressure, all of the supply from the smart money can make the uptrend, basically stop. So this is very important. And this then creates a sideways trading range at the trend top. And here it shows lower highs or an inability to make new highs. So these are the sort of first signs that we have a distribution phase. First off, you usually might see, just the trend failing to break to new highs, but eventually you will also start to see lower highs coming in. So all of these are important signs. Another important factor to pay attention to is volume. And here, volume may spike on up moves, but the rallies will eventually fail. And here, one of the most important price patterns to pay attention to during a distribution phase is known as the Upthrust. Or in other words, this is a false breakout. So right here, you can see two examples of Upthrusts for short UT. And this is, as you can see, when the price tries to break out to a new uptrend but fails. And if you are able to spot these upthrusts, you have a huge advantage, because you can either short the market, or in other words, make money when the price goes down, or if you are long and spot an upthrust, that is a warning sign that you might want to start sell, or even sell everything if you really think it's an upthrust. So your ability to spot Wyckoff distribution phases can be a game changer. Alright, so last but definitely not least, we have the markdown phase. And your ability to find these phases can be the difference between, you know, winning and losing money, because these markdown phases can be super hard, you know, if you are stuck in a markdown. And another word for this is, you know, the downtrend. A markdown is simply a downtrend. And as I talked about earlier in this course, one, you know, especially dangerous thing about markdowns is that they can go so fast to the downside, because once the markdown starts, that usually leads to fear, which can lead to even more selling, leads to even more fear, and that is a very bad cycle to get stuck in. But alright, so now let's take a look at step by step what to look out for here for the markdown according to Wyckoff theory. Well, the first thing we want to notice here is that the markdown comes after the distribution phase. So if you are able to really find the distribution phase, you might be able to avoid the markdown altogether. Or if you're shorting the market, you might be able to make a lot of money before even the markdown starts. And here, the start of the markdown is when price breaks below the trading range support. So here, this is actually wrong. It says accumulation phase here. It should be distribution. But what you can see here is that once the price decisively breaks below the support in the trading range, or the support in the distribution, this right here is the beginning of the markdown. So the markdown is this whole downtrend. And during a markdown, the price makes both lower lows and lower highs. However, what is important to mention is that they may include these short redistribution pauses, just as we talked about with the uptrend. We might have trading ranges within the downtrend. This doesn't mean that the downtrend is over, but we can definitely have smaller trading ranges inside the downtrends. So that's very important. And the markdown phase usually continues until selling exhausts and new accumulation forms. So in order to stop this markdown phase, according to Wyckoff, we need to see smart money stepping in once again to start to push up the demand and eventually hopefully getting this markdown to an end. And after that, the whole cycle starts again. But alright, so now it's finally time to take a look at the key Wyckoff accumulation events you need to know about. And if you are already wondering, what are the events? Well, the events are these things we talked about earlier, like PS. What does PS even mean? SC, what is SC? What is AR and ST, and so on and so on. In order to really understand Wyckoff accumulation, we need to, of course, understand what these mean. So let's take a quick and simple look at this. And the first event we need to know about is known as preliminary support, or for short PS. And this is basically the first buying support after the downtrend, or after the markdown that we talked about earlier, or decline. And here on the image, you can see that the PS is right here. And this one, at least in my opinion, can be very hard to spot, because most of the times this will actually be the sort of last or the next to last pullback within the downtrend. But one thing we can look out for here is that on the preliminary support, this is the first sign of smart money stepping in. So what you can look out for this PS is increase in volume, because if smart money starts to buy, we usually see some increase in volume, and we will talk more about volume later on in this course, but often this is the first sign that smart money is stepping in. The next event here is called the selling climax, and this is much more clear, because this is usually where we see panic selling. So we have a very strong move towards the downside. This move is often much more sharp compared to the move before the preliminary support. So you can see the move before the PS is shorter and not as sharp as the panic selling move before the selling climax. But what is also important here is that this selling climax is usually absorbed by strong hands, or in other words, smart money. So this the bottom of the selling climax, as you can see, is often very close to the low of the Wyckoff accumulation range. The next key event here is known as the automatic rally, or for short, AR. And this is the quick sort of bounce that happens after panic selling. This is something that you have probably seen in markets. Usually after we have seen panic selling and a fast move towards the downside, the market will immediately see a first bounce. And this is like almost like automatic. Too much selling pretty much always leads to this automatic bounce. The next event here is called the secondary test, and this is when the price goes down to retest the SC low, so the selling climax low. So this move, as you can see right here, the move goes down here and tests the SC level. Sometimes it can be a bit above, like on this image right here, but sometimes it will go down all the way to the support right here. When the price goes down all the way to the support, it will usually be easier for a trader like you and me to think, aha, this might actually be the beginning of a trading range and maybe even a Wyckoff accumulation. It can be a bit more tricky when the ST is above this level. But this is basically the secondary test here. And after all of these 4 events, this is the beginning of a Wyckoff accumulation. And this accumulation can go on for a long time, and we can see multiple tests both at the high and the low of the range. But there is one special event here that I think is by far the most important event in the Wyckoff accumulation, and that is known as the spring. And the spring here is a false breakdown below support. This is also known as a bear trap. And here, as you can see, we have a spring right here. And as you can see, the spring is when the price briefly dips below the very lowest point right here. You can see this one is even below the selling climax, right? So it dips below the support, but below the support, smart money quickly buys up the price and we see a sharp reversal. And these points, the springs, can often be amazing entry opportunities. And later on in this course, we will take a look at a spring trading strategy. So definitely, guys, stay tuned for that. But all right, so now we of course also need to take a look at the key Wyckoff distribution events. And these ones are pretty similar to the Wyckoff accumulation events, but they are a bit different. So make sure to really pay attention. The first event here is known as the preliminary supply, or PSI. And this is the first significant selling after an uptrend. So this is pretty much the opposite as with the Wyckoff accumulation. This is the first sign that smart money is stepping in to sell. So one thing I'm looking out for the PSI is increased volume, because increased volume means many times it means that we are seeing smart money, the people with lots of capital and money, stepping in to the market. So there's a first sign we can look out for that a Wyckoff distribution might be started. The next key event I'm looking out for is known as the buying climax. This is for short BC, and this is the opposite of the selling climax. This is a final surge of buying getting exhausted. So this is like the final push when, you know, investors are super optimistic. We're seeing maybe even euphoria in the market, but even though we are super optimistic, we still can't push the price higher. And this is also usually a point where we can see lots of volume. We usually see smart money actually starting to sell their position, and the BC event tends to be near the high of the range. But as you can see, we have a few points here, UT, these ones are very important, but we have a few points that can definitely be even higher than the buying climax, but they should be at least around the same level. Next up, we have the AR. Remember, we had an AR in the accumulation as well. This is the automatic sort of reaction. And this one is usually a pretty sharp decline after the BC. So after we see a push like this, you can see this push was so long and sharp. This is a very sharp move towards the upside. After that, we usually see an automatic pullback, an automatic move in the opposite direction. After this, we usually have some secondary tests, some STs. This is when the price goes up and tests that this resistance is actually real. So once again here, this test can be a bit below, but it can also actually go up all the way and test the BC. This is basically to test the resistance. But last but definitely not least here, and this is the most important event, at least in my opinion, in the Wyckoff distribution, and this is the Upthrust or UT. And this is when we see the false breakout above resistance, or in other words, a bull trap. And here I have actually two examples of Upthrust. We have one Upthrust or UT right here, and one Upthrust or UT right here. So you can see that both of these is when the price quickly pushes above resistance, but smart money starts to sell and pushes the price back down. These are usually amazing short opportunities. So this can be amazing points to bet against the market, or if you are long, these are amazing opportunities to actually take profits together with the smart money. So our ability to be able to identify upthrusts is very key. But alright, so now it's time to dive a little bit deeper into understanding smart money. And to be more specific, we are gonna take a look at a concept that Wyckoff called the composite operator. What do we mean by this, and why is it so important to understand? Well, here, the composite operator is Wyckoff's sort of metaphor for large market players. So you can think about this as smart money, but this is not just, you know, one smart money player. The composite operator is as you can see right here, it's not a single player, but it's the combined effect of smart money traders. So the composite operator you can think as the combined force of all smart money traders. And the goal here of the composite operator is to accumulate at low prices. And remember, this is where the Wyckoff accumulation comes from, right? And distribute at high prices, right? And this is where the distribution, Wyckoff distribution comes from. And one key thing here about the composite operator and how Wyckoff saw this is that smart money acts in a very deliberate and even deceptive manner. So it's not just random how smart money trade. They trade in a very specific way to get to be able to buy at as low prices as possible and sell at as high prices as possible. And it's actually, you know, retail investors and traders like you and me that smart money in some sense are trying to fool or trying to deceive. This is at least the way that Wyckoff saw this, the composite operator concept. And to do this, smart money uses multiple techniques, like for example, when they accumulate positions, they do this in a long period of time. They are very careful that they don't buy too much, because if they buy too much, that might start an uptrend. It's a very deliberate and delicate buying they do in the accumulation area, and a very deliberate selling, slow selling they do in the distribution area. But here you might wonder, okay, so now I know about this composite operator concept, but how can we traders use this knowledge? Well, what we can do is that if we understand how smart money trades, we can try to align our trades with the composite operator. So we as small traders, if we can trade in the same direction as smart money, we can actually take advantage of how they trade and also make money from the smart money decisions. So as you can see right here, the goal here is to trade with the smart money, not against it. And by the way, if you are curious what this image is, this right here is Ray Dalio. He owns one of the largest hedge funds in the world, and he's a classic example of what we could call a smart money trader. He has lots and lots of capital. But alright, so now it's time to take a look at a concept that will improve your Wyckoff trading a lot, and this is very important. This is using volume analysis, and this was something that Wyckoff emphasized a lot, that we using price and looking at price is very important, but it is when we combine it with volume the real magic happens. And here we can think about volume as the footprints of the smart money. So we can sort of use volume to look at where smart money has traded, and in which direction they have traded, and so on and so on. Because when we see lots of volume, it's likely that smart money is involved. And the first concept here, the first thing we need to understand, is that volume confirms price moves. So when we see lots of volume, it makes the move more significant. So right here I have two very clear examples. First of all, right here you can see that we have a very strong breakout. A breakout is basically when the price breaks a clearly defined resistance. So you can see that we have a resistance right here. You can see that the price failed to break a certain level, not only one time, 2 times, 3 times, 4 times here. Multiple times we tried to break a level. But then eventually we saw a strong break. You can see this green candle right here, very clear break above resistance. And it was not only a clear breakout, because if you look down here at the volume, you can see that we had a sharp increase in volume as well. And this, when we see both strong volume and strong price action, this makes the move even more significant. However, if we instead look at this image right here, where we had an example of a false breakout, you can see that just as before, we saw the price breaking a clearly defined resistance right here. Clearly defined resistance, we broke it. But if you look down to the volume, you can see that we saw no significant increase in volume. This makes the breakout more likely to fail. It doesn't mean that the breakout will fail, but preferably when we see breakouts, we want to see lots of volume. So this is an important concept. And we can also use volume to look at the significance of support and resistance levels. So when we see high volume at support, it usually indicates absorption, and that is very bullish. But when we see high volume at resistance, this usually indicates distribution, and that is bearish. So for example, if we look at this false breakout example, we can see that this was actually a pretty significant resistance, because when we saw selling pressure coming in at the resistance right there, we actually saw an increase in volume as well. But we didn't see increase in volume when we saw the breakout. So these sort of tiny signs is important, and they definitely add up. Another key thing about volume is that volume climaxes can often mark turning points. So when we see significant spikes in volume, like for example right here, they are usually significant events worth paying extra attention to. And yet another thing to emphasize here is that low volume on pullbacks in an uptrend is healthy. So in general, when we have a trend, we have impulse moves, pullback, impulse moves, pullback, impulse move. We want to see lots of volume on the impulse moves and less volume on the pullbacks. That is a general principle we want to look out for. But alright guys, so now it's finally time to take a look at how to trade springs and upthrust. And this is, in my opinion, the best way to trade using Wyckoff theory. So definitely guys, make sure to pay attention during this chapter. One thing I really like about these setups is that they can be high probability setups, and they can also give you very clear levels for where to place your stop loss, where to place your target levels. However, they can be tricky to spot. So it's very important that before you watch this part of the course, you need to have watched the rest of the course to get the full picture and to really be able to understand this strategy. But in simple terms, the spring, as you know, the spring is a part of the Wyckoff accumulation, and the strategy here is to buy when the price returns above support after the false breakdown. And when it comes to stop loss, we usually place the stop loss just below the spring low, and the target, we tend to place it at least at the top of the range, or we can use a fixed risk to reward ratio. But now to make this a bit more clear, let's take a look at this image right here. Right here, you can see a clear example of a Wyckoff accumulation, right? We can find the accumulation right here. We can see that it comes after a clear markdown, and it's not very important to be able to mark up all of the Wyckoff accumulation events. But what is important and what is crucial is to be able to spot the Wyckoff springs. And in this case, we actually have two springs, at least in my opinion. We have one spring right here, and we have another spring right here. And here, both of these springs were definitely buying opportunities. I think you could have traded both of these springs, but the spring I find most significant is this one right here. And the reason for this is that this was actually a specific candlestick pattern known as an engulfing pattern. And to be more specific, this is a bullish engulfing pattern, and that is a bullish pattern indicating a reversal to the upside. And this is an important principle here, that yes, Wyckoff theory can be very useful, but it's when we combine Wyckoff theory with even more variables like candlestick patterns, but you can also combine it with indicators or just general market structure and price action knowledge. When we combine multiple variables and find these variables at the same time, we make the trades even more likely to succeed. And this is what technical analysis is all about. We want to make the odds as good as possible. We want to flip the odds in our favor. And in this case, when we have both a Wyckoff spring, we have a bullish engulfing pattern, we have a clear support, we have multiple factors indicating that this is a good trade. But now, where do we place our stop loss? Where do we place our target and everything like that? Well, the stop loss, as we can see right here, is usually placed just below the spring low. So in this case, the stop loss would be placed around here. And you can't really argue a lot with the stop loss. When it comes to springs, you pretty much always want to set the stop loss just below the low here. Because if let's say that the Wyckoff accumulation continues here, and let's say that we actually dip below and we get stopped out and we see another spring, then you simply have to accept that and you have to enter again. but you never want to let the price go far below the stop here. So it's important to have a tight stop. And as for the entry, we usually want to enter at the candle close that closes and far above the support. So here we have the entry at the close of the bullish engulfing, right? Very clear entry point. And as for the target, you can either target the, just below the high here of the range. You can see the dotted line. So here could be, one target. Or you can use a fixed risk to reward ratio. So you measure from the stop to the entry. You take this measurement, you take twice the length, and your target will be right there. So many times the Wyckoff Springs will be a pretty quick trade, pretty quickly in and out. It will of course depend on your time frame, but as I said, you can use these methods on short-term time frames and on long-term time frames as well. When it comes to the other setup here, the Wyckoff Upthrust, this is the exact opposite what we just recently talked about, but this is when you sell or short at an upthrust. And if you want some examples of how Wyckoff Upthrust look like, I recommend to go back to earlier in the course, but you can use the exact same method here. The stop loss, we can actually make a little demonstration here. So let's say we have the Wyckoff resistance right here, and the price goes up. It quickly pushes above the resistance here and then reverses. We can once again, maybe this was a bearish engulfing, right? So we have a red candle right here. We have a green candle right here. This could be an example of an upthrust. And in this case, we would place the stop loss just above the high, right? So the stop loss is just above the high, and the target is usually at the bottom of the range. So the target would maybe be, around around here, and the entry is when the upthrust is confirmed, so usually at the candle close of the red candle. But alright, so now let's take a look at the Wyckoff trading strategy here in a simplified step-by-step manner. Because I know the Wyckoff theory, it is a lot to take in. So let's try to make a simple list here of what we need to do for, to apply the Wyckoff method. And step number one here is to identify the market phase. So are we in an accumulation, markup, distribution, or markdown? And here I highly recommend to rewatch the chapter about accumulation, markup, distribution, and markdown until you really have this, you really understand the phases. This is an important step one. After step one here, after we have identified the market phase, you see this nice little demonstration to the right, it's time to analyze the actual trading ranges, or analyze the actual trend. So if we are in an accumulation, we need to analyze the accumulation. If we are in an uptrend, we need to analyze the uptrend. Where are we in the uptrend? Are we in the impulse move or the pullback? And when it comes to if you are in an accumulation, where in the accumulation are we? And so on and so on. That's very important. Next, based on where we are, in what phase we are, you need to formulate a hypothesis. So are we bullish? For example, are we in an accumulation and you're looking out for a spring? Then you're looking out for a bullish trade. Or if we are in a distribution and you're looking to trade the upthrust, then you are looking out for a bearish trade. You need to formulate and have a clear plan if you're planning to trade, if you're planning to go long or go short. Next, and this is very important, you need to clearly define, where do I enter? What needs to happen in order for me to enter the trade? And where do I exit? What needs to happen for me to sell and take profit? And this needs to be based on the Wyckoff market structure. So early in the video, we talked about that you can, for example, trade springs. we clearly defined where to set the stop loss, where to set the entry, and where to set the target. And you can also trade Upthrust as well. But this is actually only scratching the surface, because there are tons of trading strategies in uptrends, in downtrends as well, that you can combine with Wyckoff theory. And as I already mentioned, last but not least, we need to have our target in mind as well. We need to know where to sell. So yeah guys, if you want to, feel free to screenshot this image right here so you can look back on it if you are, if you want a step-by-step guide how to apply the Wyckoff method. But now last, but definitely not least, we need to talk about some very common Wyckoff beginner mistakes that you need to avoid here. These mistakes can be very costly, so make sure guys to really pay attention. These are the pitfalls to avoid that I see happening a lot. And the first mistake here is misidentifying the market phase. So I know that I have said this a lot already, but make sure to go back in the video if something is unclear, or if you want to drop comments down below. I will try my very best to answer as many comments as possible. But please guys, don't be afraid to, rewatch this course as many times as you need in order to really be able to identify the market phase. Another common mistake here is entering too early. You enter before you get confirmation. For example, maybe you are looking out for a spring, but you enter before the spring is actually confirmed. So maybe we have a support here. You see that the price start to fall down below the support and you think, aha, this has to be a spring, right? So you enter right here just to see the price continue going down, and you will accumulate a large loss. Always make sure to wait for confirmation, and remember what we talked about earlier as well. Don't just blindly follow your thoughts that this is a spring. Make sure to confirm with other price action concepts like candlestick patterns, like other market structure concepts, to make your trades more likely to succeed. Another very common mistake is that you completely ignore or misuse volume analysis. So once again, make sure to look back on volume analysis if you want to learn more. And I also, by the way, have tons of other courses and videos here on the channel. I have a course on volume analysis that I highly recommend to watch if you want to dive deeper. I also have a video on how to use volume footprint that I highly recommend to watch. Next mistake here is that you are using improper stop loss placement. So many times I feel like people are just randomly placing stop losses. They don't have a reason why they place the stop loss at a certain level. Always when you place your stop loss, make sure that you know, why am I placing this stop loss at this level? Yet another common mistake here is fighting the trend. In general, it's so much easier to trade in the same direction as the trend. Remember, our goal by using Wyckoff theory here is to trade in the same direction as the smart money. So don't try to trade against the trend. There are many valid trading strategies you can use to trade against the trend, but they tend to be harder. So especially for beginners, I highly recommend to trade in the same direction as the trend. Another common mistake here is actually over trading. So when you learn a framework like Wyckoff theory, you might start to look at charts and find these accumulation, or at least you think you find these accumulation and distribution phases everywhere. But this is many times you can overanalyze and basically overtrade. So it's much better to focus on quality over quantity here. And next mistake, and this is super important and very common mistake, is that you expect every pattern to be textbook perfect. And this is just not happening. In real markets, the patterns will never be perfect. You will never find the perfect accumulation range that exactly follows the images I have used here in the course. In real markets, the ranges will always differ a bit here, so don't expect every pattern to be perfect. But okay, so this course is actually coming to an end very soon. But before we wrap up, I want to thank you all so much for watching. And now, and this is very important, your learning journeys should not stop here. Wyckoff Trading is best used together with more trading concepts. So I highly recommend to check out this playlist next to learn even more about trading.